Trump's pivot to Bitcoin and embracing it has been pretty interesting to watch, because he was always kind of one of these guys that was like, I believe in the US dollar, to then going full-fledged orange pill. I don't know if it's pandering before an election. There's probably some of that, but I think with his recent pick of JD Vance on the vice president side, he's had a lot of positive things to say. 2 years ago, 3 years ago, it was still like the government's going to ban it. It's never going to be a thing. And now you've got BlackRock and the president candidate who's in the lead right now saying it could be a reserve asset, speaking at the Bitcoin conference. When you've got the Larry Finks of the world saying that this is something that people should consider in their portfolio. And so if you have people at that level with that much power and that much sway advocating for it, then I don't think it's unrealistic to think that if you had a pro-Bitcoin president and vice president, in the office, that there couldn't be some kind of strategy around it that would very likely turbocharge adoption as well as price.
Bing bong. I am back with another edition of the State of Bitcoin podcast, where I've got the man, the myth, the legend, Max Gagliardi, I believe is how you pronounce it.
You got it.
Yeah, there we go. So we've had a lot just go on. We're recording this on the 16th. Over the past weekend, of course, we had the attempted assassination attempt on President Trump. But that's not stopping him from coming to the Bitcoin conference. And there's rumors circulating about Trump potentially utilizing Bitcoin to help the U.S. get out of its national debt by putting it on the balance sheet. So, Max, I'm going to start it off the bat here, man. Do you think that Bitcoin is the way out for us to get out this, this never-ending debt cycle that seems like the government can't get out of?
Well, I think it's maybe one thing that they can do. I mean, obviously, going back to some type of sound money principles, look, in the past, we had the gold standard, and there's a lot of, these traditional economists that'll say, hey, look, we moved off of that for a reason and we can print as much money as we want to. Obviously, my views are that having some type of sound money strategy would be better than having none. I think that, right now, the problems probably go beyond maybe like a reserve asset, and really on the fiscal side, like the amount of spending. It seems like the only thing in politics that anybody can agree on, right and left together, is to spend more money than we make. And so the trend has not been good. We're looking, post, obviously Trump with the COVID spending and then Biden continuing it. It's just gotten out of control. And then the thing is with all these, budget deficits, is that they never go backwards. So it's like as soon as a new high watermark gets hit on what these guys want to spend, it always seems like that's the new baseline. And then they just keep increasing it from there. And the numbers are pretty crazy. And I've talked in the past, I've got a podcast as well. And I've talked to guys like Luke Groman, who can really get pretty hyped up on this idea that, maybe the US dollar could fail at some point, and whether it's gold or Bitcoin or some other type of reserve asset, putting, your money into something that has a fixed supply or a limited supply when it comes to gold is one way to protect against that. But ultimately, like, the government just needs to quit spending more than they're taking in. And this idea that we can just increase taxes, well, I'm sure they're going to do that too. But I don't know, to the extent that you can only do that so much before people that's also politically unpopular, right? So can they do that in a material way? And I think Trump's pivot to Bitcoin and embracing it has been pretty interesting to watch, because he was always kind of one of these guys that was like, I believe in the US dollar. And then he kind of softened a little bit and was like, well, if people want to have Bitcoin, that's interesting, but I still think the dollar should be the dollar, to then going full-fledged orange pill. I don't know if it's pandering before an election. There's probably some of that, but I think with his recent pick of JD Vance on the vice president side, he's had a lot of positive things to say on the Bitcoin front. So I welcome it. I mean, I think, like, look, at the end of the day, if we want to be a leader in technology, and we've got to embrace it. And I think that at this point, the ship has kind of sailed on politicians embracing it. I know there's still some that want to restrict it or ban it or do all these things. But ultimately, like, you've got active, members of Congress and the Senate that own it, that hold it. You've got presidential candidates now saying it could be a reserve asset. I just think the tide has shifted. You've also seen a lot of the dead grass burnt out over the last couple of years with like FTX and some of these bad actors that we saw that were just straight scamming people. And so that was probably a good thing. And that was a good thing that happened. And so, I typically lean towards less regulation versus more, but we all kind of knew some was coming. And so it's been a breath of fresh air to see, Trump and his new vice president pick kind of leaning in a little bit. How much is pandering? I don't know. but it's still better than the alternative, right?
Yeah, 100%. And, I think it's going to be interesting to see how this all plays out, right? Because I think, what I do like about what Trump has said is that he's always kind of recognized Bitcoin as a currency and says it's like kind of, an alternative or, almost an attack on the US dollar. Well, I'd rather have a president or somebody that is, trying to delay the inevitable of essentially, the fiat currency failing and try to remain strength in the dollar because in my eyes I think there's kind of like two directions that I see us getting to a Bitcoin standard, and I'll get into that a little bit later and ask you kind of your view on that a little bit later. But on that point, do you think that I guess like the US can turn and flip a switch and become a leader in the Bitcoin space strictly because of what we have access to? I mean, I know the government has a spending problem, but theoretically, we'd be the only country that could print dollars to buy Bitcoin and not see that initial run up right away, right? Because everywhere else is going to see, a decline relative to the dollar as soon as they start printing. But because we have that global reserve currency right now, you never know. So do you see that as like a potential future, or how do you see, I guess, like this all kind of playing out?
Well, we're already seeing us being a leader in the mining space, especially after the China ban and a lot of hash rate came over to the U.S. We're seeing states specifically embrace the mining side. I live in Oklahoma. We've seen some pro Bitcoin legislation get passed. I know down in Texas they've done a lot of pro Bitcoin legislation and posturing around that. And I think ultimately you'll see adoption in at the state level, and we're already seeing that because states are we're all inherently self-interested, but states are kind of separate from the federal government. And so we've seen politicians at that level leaning in, and mainly from one side, mainly from the Republican Party. There's been some bipartisan aspect to it, but it's been mostly, it seems like, Republican states that are pro business, that are pro energy. A lot of the states have been states that are energy rich. And so the mining side makes sense. And I've had a chance to talk to some high ranking politicians from my state. I'm not going to name drop anybody, but they were basically, they asked all the right questions. They're like, what could this do for the grid? What could this do for jobs? Was some of the questions. And, you've got blue collar jobs involved, you've got white collar jobs involved. And so they asked all the right questions and they seemed very much interested in it. And this was a couple of years ago. And I think since then, we've seen them take a more public facing stance of being kind of pro capitalism, pro business. And so, will the federal government do it? I think that they should. I don't see the downside of some type of allocation to Bitcoin. And if they're worried about, well, oh, do we lose the reserve, currency status? Like, I mean, look, if you're saying, well, we've got this as a reserve asset that underpins the dollar system, at least at some level, and it's kind of like what I tell a lot of individuals that get interested in it. It's like, well, what's it going to hurt you to allocate 1% or a half a percent or some amount to learn about it and then to kind of watch the cycles? I think that's a healthy way for anybody to get involved. And so, I don't think it's out of the question that they could go that route. I'm sure there would be plenty of like wailing and gnashing of teeth, but it does seem like the tide has shifted. I mean, look at like the multiple interviews now with Larry Fink of BlackRock. And I know a lot of purists will be like, this is not what we want. I mean, there's been vocal critics like Peter Thiel, as well as others on Twitter. Jim, I'm going blank on his last name, big economy guy that does the macro stuff, that have said this is like the opposite of what the Bitcoin's about, and it's like being co-opted by the capitalist system. But like ultimately, where was it going to go? I mean, it just seems like this was kind of the logical path that if it became a mainstream thing, did we not think that like these large asset allocators were going to get involved with it? Like that seems kind of naive in my opinion. And so when you've got the Larry Finks of the world saying that this is something that people should consider in their portfolio, that guy has a lot of power. He has a lot of power with institutions, with state endowments, people that he's obviously allocating a bunch of assets. And so if you have people at that level with that much power and that much sway advocating for it, then I don't think it's unrealistic to think that if you had a pro Bitcoin president and vice president, in the office, that there couldn't be some kind of strategy around it that would very likely turbocharge adoption as well as price potentially.
Yeah, I mean, I don't think that any of this is really priced in at this point in time. I mean, it's absolutely crazy to say that what Bitcoin 2008, Genesis block 2009, 15-ish years later that we're having a United States president talking about it and talking at the biggest Bitcoin conference in the world. It's insane to think about and talk about. And RFK Jr., credit to him for kind of being one of the first guys to do that. But there's a huge difference between him and Trump in my eyes, because RFK, running as an independent, very difficult to get in. So, but you mentioned like the mining aspect of things and kind of like states embracing it, which is interesting timing too. So I don't know if you saw this, but I saw today actually, Unusual Whales was tweeting out that Toronto lost complete power in their grid for the entire day, and it's not going to be on for 2000 or for another full 24 hours, or at least
Hmm.
that's what they're anticipating. So, I think that the mining aspect is going to be huge going forward. So, you live in Oklahoma. I was raised in Texas. I'm in Florida now, but I mean, I think the energy aspect of it really resonates with a lot of people kind of going forward. So, do you think that's almost going to be the spearhead behind it? Because I see almost like three silos of Bitcoin, whether it's like the transaction side, which I think is really developing in like, the third world kind of countries like the LATAMs, Africa, utilizing the Lightning Network and whatnot. And then there's the energy side of things, which North America seems to be dominating right now. And then there's the third, the philosophical side of things, which is more for, I don't know if like a country or a company or something like that could kind of embrace that, but it's more of like the freedom technology aspect of it. So it seems like you're kind of resonate with the mining side of things, and that's where you see the United States kind of going forward. Do you see it the same, or do you think the U.S. could ever try to move to embrace, some of the payment rails or anything along that lines, even with what we've seen recently with a lot of the Lightning wallets leaving the U.S.? Are you looking for the best way to store your seed phrase? Well, I've got it for you. It's Stamp Seed. They've got the #1 punch place where you can order a full-on package where they've got every single thing. They've got all the letters. You could just get it in there. And they've got this sick hammer, which they've engineered to make it so easy for you to punch in that titanium steel plate and store your seed phrase in the most secure way possible. So go ahead and get your Bitcoin off of these exchanges and use promo code Green Candle for 15% off. They're helping power the show. They've got the Bitcoin logo. You can punch it into your seed phrase as well. If you could see it here, they've got a lot of cool stuff. And now I'm helping empower you to get your Bitcoin off an exchange utilizing Stamp Seed and storing your seed phrase in the most secure way possible. Now get to it. All right, back to the show.
I mean, potentially. Like, I think that I don't know enough about the technical aspects of, the layer two stuff, but to me, it seems pretty basic. You have a global settlements layer that, anybody can use. I think that people will try to argue, well, they're not going to let that happen because the legacy system. But at the end of the day, like, they're going to put like KYC stuff on the on and off ramps. And so that's just going to happen. It already is happening. And it will happen. So to the extent that they can do that, then I don't see why, big companies here in the US or payments type companies wouldn't look to utilize the technology. And I don't want to get like too deep into the weeds as to how, because that's like, I'm not like super versed in how all that works, but I have used Lightning. I have done on-chain transactions. And I just think that it makes so much sense that you've got this network that's global that, can move payments around relatively quickly, depending on what's happening on chain, and with Lightning, obviously faster. And so, are there ways for existing like payment type companies to utilize it? And if those ways are better, I mean, I'm a free markets guy. So, at the end of the day, if it's something that can provide it at a lower cost or a faster transaction, or, can remove barriers to entries for different companies to use that tech, then I think people will gravitate towards that. And then they'll obviously have to fit that into the regulatory framework that's out there. Because if you want to do business and you're in a country like the US, like, you kind of have to do that stuff. I mean, I know there's a lot of purists that would say that's killing the point of it, whatever, but let's be real. Like, there will be some level of that KYC. And if you want to go peer to peer, you can still do that because it's Bitcoin. And if you wanted to buy something from your buddy or from some kind of, circular economy, then you can do that, and you could do it peer to peer. And that's possible as well. But I just think that it all comes down to how do companies and organizations figure out ways to utilize the network that are going to be either faster, better, cheaper, somehow an advantage. And if that's the case and they can do that, then the free market is going to gravitate towards using that technology. And so that's to me what's always, I started off on the energy side, got interested in mining because my career had always been kind of at this intersection between energy and monetizing that energy, primarily natural gas and oil, and figuring out ways to sell the product and to sell the energy and get the highest value price for it. During when I first started looking at Bitcoin in like 2020, it was very profitable there towards the end of 2020 to mine, and so there was a lot of stranded energy in the U.S. And so my thought was, wow, this is crazy. Gas is trading at this price, natural gas, and you could convert it into Bitcoin and get this higher price on like an MCF or MMBTU equivalent. So it kind of blew my mind. And so then I went down the Bitcoin rabbit hole and ended up liking the technology for a lot of other reasons. I just kind of bought in a little bit to the different things you mentioned around, the philosophical side of it, the store of value side, the transaction side. I realized that there's kind of two different things. There's the token and then there's the network. And then like a lot of people, the more you learn about it, the more I was like, this is not just some kind of niche cool thing to monetize like flared natural gas or stranded energy on the grid. There's actually utility here, and it is backed by this giant network of self-interested people that are running ASICs to uphold that network. And so that's what kind of led me into the fascination and into the world. And so again, like if there's something that provides a better service, like if you can store value in something that over time goes up in value because there's a fixed supply, if you can create payment rails and different technology around it, then like people are going to gravitate towards what works best, I think, unless there's some kind of overarching regulation that stymies it, which they've tried to do in a lot of ways. But at this point, it just seems like it's getting so mainstream. I mean, shoot, 2 years ago, 3 years ago, it was still like the government's going to ban it. It's never going to be a thing. And now you've got BlackRock and the president candidate who's in the lead right now saying it could be a reserve asset, speaking at the Bitcoin conference. So I think the naysayers in that camp of it's going to be banned, it's going to be all that stuff. I mean, that ship's kind of sailed, in my opinion. I think we're sort of past those arguments. People will still make them, but I think that's just the current state of things.
Yeah, it's funny being in the Bitcoin space. It's always recycled FUD, right? I mean, they'll say the government's going to ban it. They're going to ban mining. It's bad for energy purposes or whatever. And who knows, man? It's used by criminals. Like it's going to be something else that's going to pop up, and they're just going to keep reusing these, reduce, reuse, recycle, the same FUD, unfortunately. But I think that there's an interesting time that we're here, right? Because we've had the Fed and the CPI prints come out, right, where the CPI has still kind of stayed above 3, and the Fed has kept interest rates very high. So I'm curious kind of how your overall outlook on the overall economy is just right now, leaving it kind of broad stroke. And then we'll dive in a little bit. Like, do you think that the Fed is doing a good job with where we're at? And do you think that the interest rate policy that they've been implementing, hiking at an incredibly fast rate and just kind of keeping it high for a significant amount of time? How do you see this playing out as something that is going to break? We'll kind of slowly transition back into maybe the decade 2010 to 2020 time. How do you see it all playing out? Are you looking for the easiest way to get your Bitcoin off an exchange? Well, I've got it for you. It's Foundation Devices. They've got the #1 hardware wallet in the passport. They've even got a concierge service that can help you get your Bitcoin off an exchange within 1 hour private onboarding session. And they've got a great app too, which will give you extremely, extremely, extremely private features on that app, so you can use Bitcoin in the most secure way possible. So I've been working hard trying to get sponsors to help you get your Bitcoin off an exchange, and I found it with Foundation, and you can store your seed phrase with a stamp seed punch plate as well. So pair all those together, use promo code GREENCANDLE at foundation.xyz, and you'll get $10 off your entire order. All right, that's enough for me. Back to the show.
Well, I'm not an economist, but I'm fortunate to be able to talk to a lot of smart people, some of them which are economists. We also have a team of market research guys at our company that I get to talk to on a weekly basis. So I get a lot of opinions and get to kind of put them together to form my own opinion. I mean, I think that nothing here I'll probably say is too revolutionary, but ultimately, I think the Fed acted too slow. I mean, we saw inflation going up in the summer of what is that, 22, and we saw things ratcheting up. They said it's transitory, and then all of a sudden it's like, oh my gosh, it's gotten to 3, 4, 5, 6%, wherever it got to before they started hiking rates. I think it was in that range. And then they hiked it like an incredible pace. It was kind of like a makeup call. It's like, well, we missed this, and then now we're going to go knee jerk the other way. And so that caused, some things to break. I mean, we saw the Silicon Valley Bank crisis. We saw a lot of other banks failing at a magnitude that was, in some ways, depending on how you measure it, almost equivalent to like a 2008 type of banking collapse. Obviously, the government stepped in, backstopped those. And so we have yet to see like a bigger systemic failure. I think a lot of folks last year on the economy, and maybe I've said this before, we're probably all on Twitter too much, but I felt like last year was overly bearish because everybody was like so bearish during that hiking cycle. We're going to hit a recession. We're in a recession. And then like stock market kept making new highs, employment data and jobs data, things like that kept coming out. Economy data like GDP kept coming out and being like pretty resilient. And so I think last year everybody was a little bit too bearish. And then people kind of this year it's been, I don't know, it's a little bit wishy-washy. You still have the people that are saying there's always the doomsday predictors, right? That like things are going to crash and eventually they will. So, if you say it long enough, you'll eventually be right. But the economy has been weirdly resilient. And I think it's a testament to the amount of liquidity that's been sloshing around in the system. And if you look at like a 2008 or a 2020, where the last big major kind of recession type crashes that we've had that were pretty serious, you saw a lot of things happen. I mean, obviously 2020 was unique with the economy shutting down, everybody being forced to stay home, not to work. That was very supply chain driven. And then everybody came back out and, the supply chains couldn't keep up with the demand. So that was kind of a unique animal. But in 2020 or in 2008, you really saw, and this was like right around the time when I was getting out of college. So, but I still got to see it in the sense that I was trying to apply for jobs. It was like right in the great financial crisis, Great Recession was when I was going out into the job marketplace, and it just felt different. Like anything I've felt since then, it was the stock market was way down. Real estate prices crashed. There were so many things that truly happened that had a big impact, and you really haven't seen this last hiking cycle. And I think a big part of it is that there are a lot of folks in this country in the US that have fixed debt. So when rates go up, most people, the biggest item of debt they have is their mortgage. And most mortgages in the US are fixed on a 30-year basis. And the average mortgage rate is still very low. I think it's in like the 4 something percent range, or maybe even lower than that, maybe in the high threes. And so you've got, the Fed's basically a hammer. Everything looks like a nail. And so they raise rates. And historically, when there were more variable rate debt instruments, the households felt that more. You're seeing that like in Europe and other countries or Canada, where they don't have these long-term fixed mortgages. And so you see that pain show up in the consumer a lot faster. And whereas we're not really seeing it in this rate hiking cycle because a lot of folks, have their debt kind of fixed and locked in. So they're not going to see that roll through their personal balance sheet. The main thing that's stressed people, I think, has been the inflation, primarily food inflation, as well as like shelter, home inflation, rent inflation. Those things have had a material impact on folks. And so it's one of those deals where I don't think that it hasn't done what it's traditionally hiking rates as quick as they've done. I don't think it's flowed through to the consumer as fast as maybe they thought it would in a historical context. The other thing I think that people forget about is that so much of the wealth is concentrated in a small group of individuals, typically the boomers. They hold a lot of the wealth. Well, people that have wealth today, they've got risk-free. I mean, technically, everything has risk. The government could default, but you could get like treasury bills at 5.25%, 5%. And so you've got a lot of folks, especially high net worth folks, that are now able to make significant income of doing nothing. They can just sit their money in a CD or in a money market account or buy treasuries. And so, the highest concentration of wealth individuals, people buying the high luxury goods like homes, cars, things like that, they're making a lot of money right now with high rates. And so I know that if you're someone who's at the lower end of the income spectrum and don't have that type of savings, then obviously home prices going up, rent going up, the price of cars going up, food going up, you're hurting. But I think a lot of people in the economy that have money, higher rates just really haven't impacted them as much as the Fed maybe in prior cycles thought that it might. So kind of a long-winded way of saying I think that the Fed has knee-jerked into this. They're now kind of sitting here holding rates higher. I don't know when they're going to cut. I think they will cut eventually. The data now suggests maybe two or three this year. If you'd have asked me a couple of months ago, I would have said, man, maybe, maybe not, probably next year. But it does look like maybe at the September meeting, they will start to cut. It'll probably be slow and measured. But if I'm not mistaken, I think Powell is out at some point like next year, right? So who knows? Maybe he wants to be the guy that brought the rates up high and held them and doesn't want to risk that. Oh, I cut rates and then inflation takes back off and then they pin that on me because he's already got a lot of heat on him right now. So long-winded way of kind of meandering through some different topics on the broad subject, but it's something that's fascinating and interesting, and I love watching the commentary on it on Twitter and podcasts, etc.
Yeah, man. I mean, I definitely, you can't really predict what he's going to do and how that's going to play out, right? But I mean, just kind of along those lines, I think I've been kind of one that thinks that they're not going to cut until like Q4 if they're going to cut at all this year. And the Fed is also run by humans, so I think that's the beauty of Bitcoin, right? Is like Bitcoin, we have this set schedule, we know what's going to come. Fed, we don't really know. The market's been predicting a rate cut since last year at this point, so I think it's going to be something that maybe it happens to, I guess, they start cutting too late and then they're going to cut too quickly, and it's going to be something like that. So I mean, we'll see. Powell has been one that's kind of pushing for the higher for longer and all that, and so it's been an interesting to see all that play out. But you mentioned kind of seeing the strength of the dollar and everything else. I don't know how closely you follow it, or if you've had any discussions on the consumer and kind of like the job reports, but I want to get into a little bit on that because I think that's kind of like the underlying aspect of the entire economy is how the people are reacting, right? I mean, we've seen the job numbers be okay, whether you believe them or not, and the consumer is still spending. So that is a metric that Powell kind of looks at, even though it's a lot of backwards looking data. That's part of the reason why I think my theory is that they're going to start cutting a little bit too late. But do you think that the consumer is still remaining strong, in your opinion, as you're kind of like looking at these things and evaluating, where we're going?
It's hard to tell. I mean, I think the jobs report is obviously manipulated. I think every country kind of manipulates some of those numbers. We've seen it get revised downward. I think every time it gets revised downward and it goes either below, like if we have a beat, it'll get revised below down to expectations. If it hits expectations, we have, revised down to be a miss. And so there's always kind of this like, and that's never what gets reported. What gets reported is the headline number. It seems like it gets a lot less press whenever they come back in and revise it downward. And it's hard to tell. Like, I don't know. For me, it's like anecdotal. It's kind of like what I see in my local environment. So I deal a lot with companies that are based out of Texas with our company. We deal a lot with obviously people in Oklahoma, some of these energy capital states where you've got, a lot of energy companies and, the price of oil has been pretty resilient. We're in around the low to mid 80s right now. And so I have not personally seen a lot of job loss like I've seen in other times when we've gone through these commodity cycles and the price of oil may crash. Natural gas prices have been really low and very bearish. And so there's been some pain in that segment of the industry. But in general, like where I live and the folks that I know in Texas, I mean, I'm not hearing about lots of job losses. I'm not seeing lots of folks I'm not seeing it like I have in other times, like obviously during the 2008 timeframe or like the 2020 timeframe. We were hearing about it a lot in tech, and we did see that in a little bit in some of the real estate stuff we do. Like we had a couple people that were looking to buy a lot in this one development that we're doing, and I do remember back when the SVB stuff was going on. One guy was just like, "I'm too spooked with all the job." He was working in tech, and he's like, "I'm too spooked with all the job losses going on." And we saw the bigger companies like Meta and obviously Twitter with Elon. I think Twitter kind of Elon cutting all those folks and then all the other tech companies looking at them and being like, well, if he cut that many jobs and like the site kept going, it was sort of like he kind of led the way on that. But we saw, everybody from Google, Amazon, Meta, like all these big companies, lay off a lot of folks. But really, and then we also saw like in the real estate industry with rates going up, professions like mortgage brokers, while it's really hard to keep those people employed when there's a lot of commission based work there. But, one sector that I think has been propping a lot of things up with the government spending is like government contracts. Like I know a couple different friends of mine, people that I'm close with that work in like the construction type or engineering industries, and they're still getting giant, government contracts. And they've said that the shift in the weighting of their work has been higher on the government contract side versus the commercial business side than it has been in the past. Now they're seeing they've seen the commercial side weaken, and they've seen the government contract stuff continue to be strong. And so they're still spending a lot of money, and the government's pumping that back in. We saw that recent report that I think it was Illinois or one of these states where like now more jobs are being created by the government than the private sector. And so it's like, there's still a lot of money getting pumped in by the federal government that's propping up a lot of industries. And so again, just me kind of giving my thoughts here. I know I'm not like a day-to-day or month-to-month economist, like really diving into these reports, but some of that's anecdotal from the stuff I'm seeing in my local community. Some of that's just stuff that I've pieced together through the news that I've read and the other people that I've talked to. But I think where the consumer is weak that I've seen is the inflation stuff. I mean, you can't talk to anybody that's like, oh man, going out to eat now is so expensive. Like every time I go to the grocery store, it's so expensive. So, the logical conclusion to that is that they would be spending less in other areas, because if it's costing you, $80 to go to Chick-fil-A for a family of 5 and it used to cost $30 or whatever. I mean, I'm making up numbers, but it does seem like things have gotten crazy on the food side and some of these like basic things that we need, even stuff like just like toiletry stuff. If you go buy toothpaste or like mouthwash or just stuff you would get for your house, like you order it on Amazon, you're like, did I just spend like 100 something bucks on just basic house stuff like cleaning supplies and toiletries? Like, so I do think that the consumer is very much aware that those kind of necessity products are more expensive. Things like cars are crazy now. I mean, the same truck that I bought in 2019, today it's like 30 grand more than what I paid for it. And it was like a mid-level type trim truck. It wasn't even, I mean, trucks are expensive, but now I'm kind of looking at it and I'm like, this seems like it could be out of reach for a lot of folks. Whereas maybe, 5, 6 years ago, it was still expensive, but like folks could afford it. So I don't think that there's any way that the consumer is not feeling those types of pains. But in terms of like the job loss thing, I haven't personally seen it as much, but I'm sure it could be coming if we keep on this path that we're on.
Yeah, and yeah, I agree with you 100% there too. So, I mean, I don't really see it too much. And like the friends that I have that have lost their jobs have been able to bounce back relatively quickly. So, fingers crossed that it doesn't get to that point. But, you mentioned a couple things, real estate and energy markets. Now, I want to dive into the real estate a little bit later, but I want to dive into the energy markets here because I see it as a very interesting kind of talking point here where we've seen, obviously the Russia-Ukraine war kind of break out not too long ago. There's a lot of turmoil in across the pond from us, but it seems like the BRICS nations are almost pulling the energy aspect of things. Like they've got a lot of like natural gas and oil resources. The U.S. Kind of shot itself in the foot with a lot of these green energy policies. So we're starting to get out of it. But there was rumors circulating last fall and winter time that Germany and some of these other countries would potentially have like an energy crisis, especially during the winter. It didn't seem to be that way. But do you see that kind of like, I guess, the initial fears of the energy markets where, it would be too little at some point because Russia and all this stuff? Have you seen that kind of cool down? Some of those worries cool down, and the U.S. is still very powerful and very I guess big on the energy side of things, whether it's oil and gas or natural gas. Are you looking for the number one place to find all the information you can about Bitcoin, whether it's price, whether it's hash rate, whether it's the latest up to date things outside of Bitcoin, whether it's nation state adoption, what have you? Well, I've got the place for you. Check out bitcoinnews.com. They've even got the #1 newsletter in the game when it comes to Bitcoin, because it gives you all the up-to-date information on every single thing that happened in the past week. That'll come to your inbox every single Monday morning. You could sign up using this code right down here, or this link. It's also in the show notes. So come join me and thousands of other people that are getting the most up-to-date information from bitcoinnews.com and their newsletter. All right, let's get back to the show.
Well, the US has been, from a production side, it's been pretty incredible to watch. The last, call it 15 years, we are now kind of the global superpower, the largest energy producer in the world. Obviously, OPEC still holds a ton of power, specifically over the price of oil. Natural gas is becoming a more interconnected world market. We are exporting tremendous amounts of gas versus early in my career when I started, we weren't exporting anything. We are actually importing gas. And so we've now built all these LNG export facilities, which have really allowed us to increase natural gas production in the US by a lot and during my career, and it's still, the price is pretty low. They're going to continue to build export facilities into next year and into 2026. There's a bunch that are scheduled to come online. I think we're going to add another 5 or 6 Bs a day of new export demand, and so that's been huge for the world market for natural gas. I think the energy crisis did happen when the Ukraine war started, and it was very much a shock. And the world kind of scrambled. We got a lot of LNG into Europe. Prices spiked that year in 2022, which is pretty crazy. We saw nat gas here domestically go from kind of languishing the last few years in sort of the 2 to 3.50 per MMBTU range, spiking all the way up to $8 or $9 in 2022, which on a percentage change is massive. And then we've seen things kind of tank because energy producers here, when they see high prices, they just drill, baby, drill. And nat gas, we have so much gas. We sit on an ocean of natural gas here in the US that we could ramp up production very quickly to really get it to the market and crash prices back down to where they've been this year. We're sitting at, almost barely above the all-time lows for the shoulder months of like August and in September coming up. So the market is, in my opinion, and this is, our company puts out research on it. So it's not necessarily the views of the company, but I think I'm closely aligned with how they think about it. But basically, I still think I'm relatively bearish on nat gas, at least in the short and medium term. Maybe when that LNG capacity comes on next year, we could see domestic gas prices get an uptick. That's what the forward strip pricing shows. But I still think that there is plenty of reasons to be cautious in the near term for price to be low or to continue to go down in the forward months. From the oil side, I mean, it's kind of all OPEC. I mean, we can talk about China demand. We could talk about production numbers, but ultimately OPEC continues to have production cuts and continues to signal that they're going to hold those cuts into the future. During the Biden administration, we've seen a country like, Iran go from producing, I think, a couple 100,000 barrels now up to over 1 million barrels a day. And so that's not good for us, for anybody that's an enemy of Iran, which lots of people are. And so we have seen production increase there. But we've also seen OPEC come in and cut. And I think that they want to have a stabilized price, if I had a guess, in the $70 to kind of $100 per barrel range. And really, like, a lot of these countries don't have a big incentive, in my opinion, now to or to increase production to a level where we would crash oil back down to the $30-$40 range where we saw it kind of in the decade of, call it 2014 through 2020 and the big COVID price crash. I mean, since coming out of COVID, there's been a concerted effort by OPEC to prop up the price of oil, much to the dismay of the current administration, who's released a lot of barrels from the SPR, the Strategic Petroleum Reserve, and tried to artificially keep the price low from a political standpoint. But right now, I think that the world is well supplied with oil, and I think that OPEC is going to continue to keep it as much as they can balanced. I think natural gas, at least domestically here in the US, I don't see like a big breakout in the near term on price. So that's kind of general views on the energy markets today, but could go deeper on anything if you want.
Yeah, man. If you want to go deeper on like the oil kind of aspect of things and kind of how we're improving on that, I think that'd be great. Because I think, with with everything being said, right? I mean, obviously we've had the strategic reserves kind of deployed by Biden, and it seems like every time I get on Twitter and there's somebody talking about natural gas and oil and all that, it seems like the U.S. is going to be running out, right? So it sounds like from your perspective, we're doing just fine, and everybody's just sounding the alarm bells for no reason. Would you agree with that?
Well, I mean, I think from a location standpoint, like of new wells to drill, the Permian Basin's been the big growth engine. So, West Texas and southern New Mexico have been the big drivers of the new production. Other basins are marginally increasing production. We have seen some other basins with some meaningful growth, but really the story is the Permian. And to the extent that the best locations get drilled, eventually, and I'm talking kind of 7 to 10 year timeframes, locations can get challenged in the Permian Basin, and we're seeing that manifest in M&A activity with these bigger companies that need to add inventory, making acquisitions in other basins. And so the M&A front has been pretty crazy on the upstream side. So the drillers of oil and natural gas, there's been a lot of consolidation in the industry, a lot of groups, a lot of companies that are positioning themselves by acquiring non-Permian Basin assets for a future where Permian inventory does run low. So it is a finite resource. A lot of people like to look at things like annual data or quarterly data, but if you take a longer term view, yeah, I mean, like at some point, we're going to drill all the best locations in the Permian. I still think we'll come up with new technologies. Every time we think that we are running out, we figure out a way to drill deeper, different completion technologies to do longer laterals, things like that, with these wells that didn't unlock more resource. So oil, at least in the near term, I think is we're going to be all right on production, but longer term, I think you'll see more exploration activity pick up and us try to find more oil reserves that are economic in some of these other basins. And I think that we are in a place again where I don't think OPEC wants the price to be super low, and so they're going to try to support it the way that they can through production cuts. Now, what's funny is a lot of times, obviously the Republican Party is more pro oil and gas, and the Democratic Party is kind of anti oil and gas, but weirdly, if you look through time, it seems like prices are like higher and the industry does better when Democrats are in office. And then prices have historically kind of crashed when Republicans are in office. So I don't know if that's coincidence or if it's, not necessarily policy driven, but kind of makes sense in some ways if you think about it. Like, if there's more production and it outpaces demand, then prices go down. And if there's a party in power that creates an easier regulatory environmental for people to environment for people to drill and production goes up, then prices could be lower. But we'll see. I mean, I think that Trump has done a lot of talking about how he wants us to continue to drill and how prices were lower when he was in office. And that sounds great to somebody who doesn't understand it. But if you're somebody in the industry, you're like, I don't necessarily want like super low prices. That's when everybody gets laid off and when we go through a downturn. So it's interesting. I mean, I think as much of the rhetoric that Biden's had against oil and gas, he's also like released a ton of from the SBR. It's like, wait, do you not like it, or do you want us to use more of it because you keep taking it out of reserves and giving it to people to use? And so it's just funny to watch like the political tap dance that these guys do. He's trying to cut deals with Iran to let them flow more. He's talking to Venezuela, like people that are like our enemies or that are these countries that we wouldn't necessarily identify with American values, and he's like asking them to produce more, and then he's releasing more from the strategic reserves. And I'm like, so which one is it? Do you hate oil and gas, or because you really seem like you want people to produce it? Well, the reason why he wants them to produce it is because it makes the price go lower, and it makes prices at the pump go lower, helps with inflation, and it helps the economy, and hopefully what he wants is to get reelected. And so when people are paying $4 or $5 at the tank to fill up, that's bad for who's ever in the White House.
Yeah, 100%. And yeah, I mean, it is interesting that you kind of lined that out. I didn't know that about their differences between the Republican and the Democratic candidates. But you spoke about it a little bit earlier about housing, and that's always kind of like a hot button topic when the economic issues are kind of like murky underneath the surface. Now, I'll leave it broad here, and then we can kind of dive a little bit deeper. But how are you viewing the overall housing market right now? I know you got a couple like rental properties or like Airbnb stuff that you're working in. So how are those things doing, and how are you viewing it? Just from like maybe an anecdotal or a total country view as well. Are you looking for the best way to orange pill your friends and family? Well, I've got a way for you that's got a little bit of a nostalgia factor. I've got Bitcoin trading cards. They've got the Genesis pack. I've got an open pack right here, sitting here, where you can hand out a bunch of these cards with some great, great artwork. We've got tyranny. We've got fear, uncertainty, and doubt right here, the FUD card. So we've got a lot of great things to teach you a bunch of lessons about Bitcoin and the current space. And they've even got some cool things of cool people even doing some stuff in the Bitcoin space. I've got the Bitcoin racing card here, even signed by my boy, Chris Primetime McKenzie. So you can get all of that at btc-tc.com. Use promo code GreenCandle. You can get 10% off your entire order to orange pill your friends and family and collect some cool artwork of people that are doing some awesome stuff in the Bitcoin space and help spreading that orange pill around the globe. All right, enough from me. Back to the show.
I think real estate's interesting because every asset class is kind of its own thing. And if you want to talk about like residential housing, you can look at these like nationwide stats and they're interesting, right? They tell you kind of broadly trends in the market, but ultimately a lot of it's kind of, that local at the local market. Like for example, in 2008 in Oklahoma, like we had a little bit of a price correction, but it wasn't nearly like what you saw in states like California. We had massive price crashes. And I think that, ours hadn't gone up as much, so they didn't fall as much. It was sort of like pricing just stayed sort of, they didn't really see a lot of increases. Maybe there was a slight price correction in like 08, 09, and then really, but it wasn't as dramatic as other places. And right now you're hearing places like Austin where there was a huge boom in new builds going in. And it seems like every week I see a story about some housing development that's going under there, or somebody that bought a house for 600,000. Now it's worth 400,000. So it's hard to talk like, broadly around the housing market whenever each of these individual markets in each state and even in each city kind of have their own thing going on. And it's going to be, a factor of the inventory that's been built. It's going to be based on, what prices have done. If prices went way up, then they really quickly, then they may have room to come down faster. And so, one thing that's been kind of interesting to watch, I think, across a lot of markets is that how resilient home prices have been. I mean, now mortgage rates are in the 7% range. They've gotten as high as, we've heard 8% anecdotally from some folks. And yet I'm still seeing, what I would call, at least in my local area, what seems to be relatively healthy. I don't think prices have like gone up as much the last couple of years, like call it the last 18 months, but it doesn't seem like they've crashed a bunch either. And, in the neighborhood I live in, and then in like the neighborhoods around us, I mean, it seems like stuff's kind of moving. I mean, in my neighborhood, I'm kind of shocked. A lot of houses are going on the market and they're only there for less than 30 days, especially the good ones, right? Like if it's a good house and it's updated and it has the things and it's priced, relatively fair. I mean, it seems like it's getting snatched up pretty quick. So I think it's from the housing perspective, if a place is overbuilt and if prices got too hot, then yeah, you're seeing some corrections. But but in a lot of areas, I still think it's been resilient, much to a lot of people's dismay because they thought, oh, I'm going to get this great bargain deal and be able to buy houses when the prices crashed, and they just haven't crashed. I think part of that has to do with supply being limited. I mean, when the Fed raises rates, you think a lot of people think about it from a demand destruction side. It's like, well, now people can afford less. That's going to cause less consumer demand. But something like housing, I mean, people kind of need it. And a lot of folks, if they need it, and if your job forces you to move, like you're going to probably go buy a house. Like you could rent, but a lot of folks, if they have the money, they're going to buy. And a lot of people have been buying homes, I think, with the expectation that when rates come down, they can refinance them. And so there's still been what I would say seems to be a relatively healthy housing market on that front. And the other thing is that when the Fed raises rates, it also has an impact on supply. So if you're a home builder and you're worried about increased rates causing demand to slow down and you're borrowing money to build homes, well, now guess what? Your cost of capital is higher. So you're probably going to slow down on the amount of houses that you're going to build or apartments that you're going to build because it's costing you a lot more money in financing costs to build that same house or to build that same multi-unit development. And so some of the stuff like the multifamily stuff, you got longer lead times. Some of these projects take 2, 3, 4 years. And so some of them were already in process and they just had to finish them. But if you're somebody over the last 18 months, last 24 months that was thinking about starting a new development or to build more houses, you probably, pulled back on your plans because you're worried about the rates being higher. And so I think that that's naturally going to cause a slowdown in supply. Less supply means that the existing homes, probably trade for a higher price because there's less new ones coming on. So it's just there's a lot of ripple effects with the Fed raising rates that doesn't necessarily just go directly to a housing pricing or housing crash, right? And the other thing is the fixed rates that I mentioned earlier that people have on their mortgages. If it's 2008 and everybody's doing subprime mortgages and all these people have, 0% down or 5% down and they've got a floating rate, and then all of a sudden the price crashes for your house and so you didn't put anything down, now you're underwater on the equity side, and oh by the way your interest rate keeps going up because it's variable, well then you're in a really bad situation. And you saw like these waves of foreclosures, waves of people trying to sell, not everybody running for the door at the same time, and they couldn't get out. Whereas since then, there's way more fixed mortgages, and because we haven't seen the price crash like we did in 2008, people don't necessarily feel like they got a fire sale. They're like, well, I've got this 3% rate locked in, and the value of my home has kind of stayed up where it is. I'll just keep making my payments and hold on to this thing unless like I absolutely have to move because I lost a job or need to move for work or something like that. So that's on the housing side. The other sectors in real estate have been interesting. Office has been kind of a dumpster fire. The work from home thing I think has kind of changed office probably forever. I still think, triple A, really well done office space can still get rented. And I've still seen and heard of people doing office and making money doing it. But by and far, there's just way more people that are working from home, even to this day. Our company's gone since 2020 to more of like a flex schedule where we can let folks work from home a few days a week. And so we haven't downsized our office, but in theory, we probably could have, and a lot of folks have, right? They've downsized the office space that they rent. So that's an area where, I mean, I'm not telling you anything new. You've seen a ton of headlines of distress in the office side. The Airbnb space that I've done most of the real estate investing on. We did single family homes and stuff in the past, but in that space, I think that what I've noticed the most is that groups have gotten, a lot more professional, and where it used to be 4 or 5 years ago, you could just buy like an Airbnb place and rent it out and it would do well. Now you've got groups like ours that have really taken it more serious, like a business that have invested in really top tier properties with great amenities, swimming pools and awesome lots with waterfront or great views. We, invest a lot in marketing and social media and, property management and all these things. And so I think that, at least from our portfolio, this has been a great year. And last year was a great year. But, you're hearing a lot of people that are distressed in that space because they're just some mom and pop that bought a place and just thought this thing's going to print money. They don't market it. They don't have good amenities. It's not a great lot. It kind of just blends in the listings. And so that's a space where I think that, I caution folks. I think it can be a very lucrative and great space to be in, but you have to take it serious. You have to run it like a real business. I think kind of gone are the days where you can just sort of have one and kind of passively generate income. You have to be good at operating that business, and it's a hospitality business. So went through a couple different sectors. Happy to talk on any more, but just some of my broad thoughts on the real estate front.
Yeah, I want to dive into Airbnb because you kind of brought that one up, and that's more of, I guess, yeah, in the hospitality sector, and it's kind of been, I don't know, like the narrative of people who aren't in real estate that Airbnbs are the reason for people home prices being driven up. Obviously, they want to like blame somebody and something, but is that kind of the way you see the industry trending? Is like maybe the mom and pops. And I don't know if you actually saw this too. This just popped in my head, but the rent controls aspect of it, where we might see more people trying to go into the Airbnb, but maybe failing. I know we had that boom in the 2020s, but Biden potentially is going to put a cap on 5% increase on rents. Obviously, we've seen insurance skyrocket all over the country, 20% on average, maybe even 30% in certain areas increase. So I guess, like, are you a little bit worried as to where like the Airbnb sector is going? Or do you think that that's always going to be kind of some strength, whether it's, kind of avoiding some of the regulatory stuff and people kind of coming at the Airbnb investors?
Well, I think like the rent controls thing was, I believe, targeted against kind of multifamily or people that own more than 50 units. So it'd be the larger operators. And I also think it's something that's kind of just pandering to where it has to go through Congress anyways, and it it probably isn't going to go anywhere. And I think price controls in general just don't work. And so I mean the market's setting the price of rent. If someone's charging too high of rent, people aren't going to rent from you. They're going to go rent from the guy that's charging less. So it's just another one of these sort of like fake things that they're talking about that number one isn't going to work. Number two probably isn't going to pass. And even if it did, it's going to have ill consequences because it's not going to correct the market. It's just going to probably reduce supply, which is going to make rents go even higher. Right. So on the Airbnb front, I think it's interesting. I've never played in like the kind of single family home Airbnb space. Like I just buy a house in like Austin or something or some city, Oklahoma City or wherever, and just rent like a single family home as an Airbnb. I know people that do that. I know people that do it in like college towns and things like that. And I've heard some folks having success with it. We've always focused on like vacation markets. And from a regulatory standpoint, the market we're mostly in is very light on regulations. The one main tourist town in that area did get they incorporated and became a town, and they are putting more taxes on the Airbnbs that are in the city limits, which we only have one that's in the city limits, luckily. But that is just an example of where, I mean, anytime you're in any type of real estate, the regulatory environment can impact the economics of your investment. And there's been areas like I just stayed at a beach house in Florida last week, and the owner of the house told me that they don't rent it. They did at one point, but the little island strip that they're on, this community, they passed a law or an ordinance to where you can only do long-term rentals. So you can still rent it as an Airbnb, but it has to be 30 days. So you can't, someone would have to rent it for a whole month. And these are like pretty big, nice houses, like kind of on the beach. So basically, he said one of his neighbors was like, yeah, I'm selling this place because before I was Airbnb and it making a ton of money. And now like I can only do these 30-day rentals, and it just killed the economics on the investment for me. So there's always going to be that regulatory risk. And I think that people should understand the area and the jurisdiction that they're buying in, what's the keep up to date on what the laws have been, what the city's been saying that they're in. And, New York City is another example, like they've banned Airbnbs. And so, what did that do? That made the price of hotel rooms go up. And who was behind it? It was probably the hotel lobby, if I had to guess. But that's always a risk. I think the long-term viability of Airbnb will always be there. We've always liked to focus on kind of larger homes with amenities, and I like those because even during times when the economy is doing bad, you've got lots of rooms. You can split it with multiple families. Like most of the people that stay at the places we have, they'll bring 3, 4, 5 families or these bigger homes, and then they can split the cost of that up among a bunch of different groups of people, and they can still be relatively affordable on a bedroom by bedroom basis. The other thing with bigger houses with a lot of amenities and stuff like that is you have more room to move in your rates. Like if you've got a 1 bedroom house and you're charging $250 a night, well, how low can you really go? If you go to $100 a night or $50 a night, like you're probably not even making money. And so it's like you don't really have as much compression or flexibility in your rate versus if you've got a house that can sleep has 7 master bedrooms and a giant bunk room, and you're charging, $2,000 a night in the summer or 2,500 during peak season, you could probably move that rate all the way down to 700, $800 if you had to, and you could still make money at that rate, and you'd probably have more bookings. And so there's things you can do. Again, like I caution people just to jump into that space without like knowing what they're doing, because if you do it the right way, I think it can be really lucrative and there's a lot of advantages to it. But I think a lot of folks just kind of take it as oh, this is easy type of thing. And they don't really know all the nuances, like the right design for the house, like how to price it, like how to do marketing, all these different things I mentioned. And I think that's where folks can get in trouble.
Yeah, 100%. But Max, you've been very generous with your time. I feel like we can talk for hours on all these different topics because we cover a lot of the same stuff. So, but Max, why don't you tell people where they can find you, and yeah, what else you got going on?
Yeah, you can. It's just Max_Gagliardi on Twitter. Same thing for the YouTube channel. I have a podcast called Always Be Building. It used to be an energy focused podcast, and I did like 160 episodes of that. And then I just decided to make it something broad. And I talk about everything from entrepreneurship to the markets to just personal interests. I mean, whatever it may be, like, anything I want to basically. But a lot of it falls into like the entrepreneurship and kind of the markets in general type of categories. And so it's the same as my Twitter handle, Max_Gagliardi. And so you can subscribe or, check me out there. And, Yeah, well, thanks for having me on. It's been great. I love the broad topics. It kept it interesting and it was fun.
Yeah, 100%. We'll have to have you back on in the future. So, Max, thanks so much.
All right, thanks, Brandon.
Thank you for tuning in to the latest episode of the State of Bitcoin podcast. If you really enjoyed this one, I've got another one cooking up for you. You can click that right here and you can go to the next episode, which is an absolute banger where I'm bringing you only the latest and greatest guests. Or if you're looking for more macro related content, you could check out my other channel, Macro Insights Pod. I got it linked for you right here. So where I'm bringing you more about stocks, real estate, traditional finance stuff. So go ahead and check that out. And if you enjoyed this podcast, go ahead and hit that like, hit that subscribe button, and tell a friend to tell a friend. All right, enough from me. I'll see you at the next one.